THOR Industries, a leading wholesaler of recreational vehicles in both North America and Europe, recently reported their quarterly earnings for the 3 months ending 31st of January 2023. THOR owns a pretty wide collection of brands that are quite well known in the RV sector at this point. Brands like Airstream, Jayco, Tiffin, Swift, and a basket of different brands now in Europe through their acquisition of the Hohenheimer Group. And they're a very interesting company and stock to follow. They have a pretty good long-term track record of growing their revenue and earnings and equity and stock price for the business, yet they operate in a very cyclical industry. Recreational vehicles are discretionary purchases, and for that reason, when economic times get tough, the RV sector is one of the first ones to really feel that squeeze on consumers' budgets. But on the other side of the spectrum, they're also one of the first companies generally to see a recovery as the economy improves. And to that point, the last couple of years for THOR have had a couple of factors really working in their favor. One, we've had very low interest rates. A lot of recreational vehicle purchases are financed, so that has definitely been a tailwind for THOR. And secondly, we've had a pandemic, which really caused a lot of people to do much more local travel than they probably have done in the past versus, expensive international holidays and flying overseas. But in this recent quarter, we're now starting to see a significant slowdown in THOR's underlying business, and I think it's a really interesting kind of case study of a business that is pretty high quality when you even out all of the bumps, yet those bumps do exist and the company has to manage through it. So in this video, I want to go through what management had to say about the most recent quarter, what their latest financial results were in terms of revenue and earnings, and also some of the guidance that THOR have just recently started providing. We'll talk through their current cash flow and debt situation, and we'll also go through some of the individual segment results for THOR's different lines of business. So if you enjoy the video and haven't subscribed to the channel already, please be sure to do so. And before we get into today's video, we do have a sponsor for this one, and this video is sponsored by ShareSite. ShareSite is the portfolio tracking and recording software that I've been using personally for several years at this point to do a couple of main things. Firstly, it allows me to track the true returns in my portfolio considering capital gains, dividend income, and also currency fluctuations. But importantly, I can also generate a few different tax reports at the end of each financial year, and it really makes tax time much simpler than it would be otherwise. You can also import all of your transactions either directly from your broker or by uploading it through Excel spreadsheets, so you can even do it manually if you want to. So if you're interested in checking out ShareSite for free, there is a free version you can use forever. Head to the link sharesite.com/investingwithtom. That link will also get you 4 months free off of an annual premium subscription. Now, as I mentioned earlier, THOR is a relatively cyclical business. They do go through pretty major ups and downs in terms of their sales and profitability, basically with the general economy and with the consumer's ability to spend. So for a bit of context before we get into exactly what's happening kind of this down cycle as it seems to be starting out here for THOR, I thought it'd be interesting just to talk through what THOR's performance has been like in previous down cycles. Because despite THOR Industries operating in quite a cyclical business where their sales go up and down all over the place, they've managed to maintain positive profitability for all of the last 40 years. So they're not like the traditional automaker, for example, where a small change in revenue can really dramatically change their profitability and push it really negative. The drop in revenue, of course, has an impact on profitability, but they've been able to maintain a flexible cost structure that allows them to move their costs down as their revenue comes down as well. Throughout the last several decades, they've also started to build up a pretty good track record of long-term growth, and actually each downturn that they've had has been more profitable than the previous downturn, and some of their latest guidance suggests that that might be starting to happen again. And you also have a management team that's been in place for quite some time. Most notably, the founder is still on the board. He has a personal stake in the company as of recording of about $160 million, so there's a lot of incentive in in sort of very high level management at THOR for the company to continue to do well. And I should say that probably not all of the industry boom kind of benefits that came for THOR in the past couple of years are gone now that the industry is starting to slow down. It did genuinely pull in a lot of newer, younger buyers, and traditionally for THOR, those are the types of customers that have maybe started out with a cheap kind of camper trailer, for example, and they've tended to be customers for life. If they can start in their 20s or early 30s, for example, with a cheaper THOR product, traditionally those customers have gone on to upgrade to more expensive trailers over time and potentially even move to motorized RVs eventually. So with that bit of background out of the way, let's jump into some of the high-level financial results that THOR reported this quarter. Now, they said net sales for the second quarter were $2.35 billion, a decrease of 39.4% compared to the record second quarter of fiscal 2022, and a decrease of 14% over the same quarter of fiscal year 2021. Consolidated gross profit margin for the second quarter was 12.1%, a decrease of 530 basis points when compared to the second quarter of fiscal year 2022, and a 310 basis point decrease compared to the second quarter of fiscal year 2021. Earnings per share for the second quarter were 50 cents per diluted share, down from $4.79 per diluted share in the same period of the prior fiscal year, and down from $2.38 per diluted share in the second quarter of fiscal year 2021. Net cash provided by operations for the first half of fiscal 2023 was $185.3 million, as compared to net cash provided by operations of $298.1 million for the first half of fiscal 2022, and net cash used in operations of $88.6 million for the first half of fiscal 2021. The company revised its full year fiscal 2023 net sales and diluted earnings guidance with a current net sales estimate of between $10.5 and $11.5 billion and diluted earnings per share in the range of $5.50 to $6.50. And just to provide a bit more context here, because there are some pretty major revenue declines that have come through this quarter, down 39.4% year over year compared to one of the big boom quarters last year. So let's just take, say, the midpoint of earnings guidance that THOR have provided for this year, which would be about $6 per share. Now, THOR has about $70 approximately of book value per share, so that would still come in at about an 8.5% return on equity if they were to achieve the midpoint of the guidance they've provided. Now, the 10-year median return on equity for THOR is right around 20%, or a little north of 20% actually. So compared to that, it's certainly down if it's only going to be in the 8s. But if you compare that to another kind of metal bender type business, an auto company like Ford, for example, a business like Ford can easily go into negative returns on equity and can become unprofitable, certainly with revenue declines that large. As of recording, the stock's trading at about $80 a share for THOR, so that would imply about a 13 times earnings multiple. As far as I can see, the very long-term average is about 15 times, so we're right in around, historic average earnings multiples on what will likely be relatively depressed earnings. And like I mentioned earlier, each downturn for THOR has tended to be more profitable than the previous downturn. I'll put their annual earnings per share up on the screen here so that you can see that. Last time around, they bottomed out at $2.47 a share, which admittedly did have some costs in there from a large acquisition that they did in 2019 of the Uwenheimer Group. But nonetheless, that guidance of $6 a share is going to be about 2.5 times greater than what they earned in the previous downturn. And that $6 of earnings per share would have been a record back in 2016 or 2017. Now, in terms of cash flow, THOR remains cash flow generative, free cash flow generative. They had $91.3 million of operating cash flow. They also had $45.1 million of capex, so 91 minus 45 gives you $46.2 million of free cash flow, and each quarter they do state their capital allocation priority, and that remains consistent again this quarter. Firstly, invest in THOR's business. Secondly, pay THOR's dividend. Thirdly, reduce the company's debt obligations. repurchase shares on a strategic and opportunistic basis, and finally support opportunistic strategic investments. That capital allocation framework has been consistent for a reasonably long time now at THOR. The only change really is that they're starting to buy back material amounts of shares for the first time really. Over the past 12 months, the shares outstanding by my calculations is down about 3.3%. Now, one of the main things I would tend to pay attention to with a situation like this where a company is starting to go into kind of a down cycle is I would want to pay particular attention to what their debt situation is. Do they have any major debt payments coming up? What's happening with their interest rates and what's kind of the profile around that? And THOR is reasonably conservatively financed. For a long time, they had no debt at all. They did take on a reasonable amount back in 2019 to make the acquisition of the European business. So I think it's a good time to revisit that. Now, if we look through the recent annual report that came out this quarter for THOR, we'll see that they've got no major kind of principal debt payments due for quite a long time. Most years it's nothing over $30 million, but they do have a big payment due in 2026 of about $1.2 billion. So they've still got quite a bit of time until there's any kind of big lump sum payments of debt due. On the interest rate front, it's a little bit more of a mixed bag. Now, THOR does have a mix of US dollar denominated debt and also debt denominated in euros, and they also have a mix of fixed rate and floating interest rate debt. Now, it's somewhat complicated, and there's a lot of footnotes in the annual report that kind of explain all the different tranches of debt and what the interest rates are and that type of thing. I've teased out of those footnotes not all of the debt that THOR has, but north of 80% of it, certainly all of the big liabilities that THOR has, and I've tried to simplify it right down into a table, which I'll put up on the screen here, and you'll see that there's, like I say, a mix of fixed and floating rate debt, and there is some debt in the equation there that THOR has seen the interest rate move up on over the past year. Overall, I think they're probably still generating more than enough cash to meet their debt obligations, and importantly, they don't have any kind of major big balloon payments of debt due in the next couple of years. But that said, some debt is always more risky than no debt, and particularly in a very cyclical business, it will be one to pay very close attention to as THOR continues to go through the next few quarters. Now, in terms of some of the segment results for THOR, they do break out their business into three different components. So one is the North American Towable segment that has really been like a superstar segment over the past couple of years. Secondly, there's North American Motorised, and finally there is the European business. But at a slightly higher level, one of the things that has again been a big kind of standout factor at THOR, particularly through those boom years over the past kind of 2 years, has been one, very low dealer inventory, and two, very large order backlogs. Not surprisingly, as retail sales have started to slow down, dealer inventories levels have started to build. THOR is a wholesaler. They sell the recreational vehicles to the dealers who sell to the end customer. So if there's fewer end customers purchasing RV products, naturally the inventories and the RVs on the lot at dealerships do tend to rise, and that does have an impact on THOR's business. So in terms of where the inventory is at the moment, because it's something that THOR monitors very closely, it's probably getting back to about pretty normal levels in the United States after been at fairly low levels in the past couple of years, but the order backlog has diminished significantly. THOR now has a backlog of about $6 billion, which is a little more than half of their annual sales, so still a pretty significant backlog, but relative to what it was a year ago, it has shrunk quite a bit. So in terms of the North American Towable segment, net sales were down 58.2%, and gross margin was down a lot. Now, this was probably the low light for me in terms of THOR's overall results. Gross margins went from 19% in the same quarter last year to 6.4%, which is a pretty anemic gross margin. If that were to happen across THOR's entire business, I think they would probably become unprofitable. That's a very low gross margin. They did release some further comments on this in their Q&A kind of PDF that they put out each quarter. They said the reduction in gross margin was driven primarily due to significantly lower sales levels, extended plant shutdowns, and strategic pricing actions taken in the current year period, while a return to incentives and promotional activity, consumption of higher cost inventory, and increased warranty costs as a percentage of sales secondarily contributed to the year-over-year decrease. Of note, we faced challenging comparisons to the record second quarter in the prior year as net sales decreased 58% on a 65% decrease in unit shipments. So I did somewhat expect to see this from THOR this quarter, although it's probably a little worse than I'd anticipated. I do follow quite a bit of content here on YouTube from a YouTube channel called RV Business Magazine. They often do interviews with independent dealers or sometimes CEOs from THOR subsidiaries or other RV companies, kind of just talking to people in the industry all the time. And a lot of the dealers did bring up the fact that they had inventory that was starting to age quite a bit. They had for example, 2022 model year RVs coming in, and they still had maybe some 2021 models still to clear. So that is certainly not going to be a tailwind at the very least for gross margins. And final couple of points on the North American Towables segment. Market share was up slightly, up 30 basis points to 42%, and they had an order backlog in that specific sector of $1.2 billion. In terms of North American Motorised, similar trends, revenue and margins still down, but certainly not as bad as the Towables segment. So net sales down 24.4%. Again, they must be doing quite a few price increases, or there's at least a product mix change here, because sales in dollars down 24.4%, but units were down even more, 26.3%. Gross margin down from 16% to 14.5%. Market share was also up in this segment, so up to 48.3% for calendar year 2022, and they had an order backlog in that segment of $1.8 billion. Now finally, the European segment for THOR. This one has actually been a bit of a kind of drag on the overall business the past couple of years. There's been a lot of kind of issues getting chassis for the motorized RV products sold out of Europe, which make up a larger chunk of the European business than the motorized RVs do in North America. But now this is starting to actually improve and sort of offset some of the pain that's been felt in the North American market for THOR. So net sales still down 10.6% in dollars, down 15.3% in terms of unit shipments. Order backlog of $3.1 billion, which is quite strong, and actually an improved gross margin, so up from 12.2% to 14.1%. And in terms of dealer inventory, the inventories I showed a little earlier in the video were largely around North America. Inventory is actually still depressed a little bit for the European segment of THOR's business. Again, they're really just struggling to get enough chassis to build the RVs that they need to build. So THOR, of course, is a cyclical business, and it's certainly remaining that way, as we've just seen in this latest quarter. Now, I think with any business like this, it's important probably not to read too much into a single quarter or even a couple of quarters worth of results, both good and bad. And this is certainly a rougher quarter than THOR have experienced in the past couple of years. So I want to just kind of go up a level, go to kind of a higher level view of where THOR is currently at in terms of its track record, its current valuation, and how I sort of think about some of the different aspects there, and also talk through some of the publicly stated kind of future goals for THOR and what that could potentially mean for investors as well. Now, traditionally, THOR has grown in a couple of different ways. Firstly, they've kind of just grown with the industry. There's been a general upward trend in the number of RV shipments over the past couple of decades, and they've also grown in terms of the pricing that they've tended to charge for RVs over time. They've got a very wide range of products, like I mentioned earlier in the video. It could be $20,000 to like potentially $900,000 with some of their Class A Tiffins, but they have grown generally through price increases across most of their units. But the big driver for THOR really has been through acquisitions over time. They started really just with the Airstream brand in the 1980s and have steadily acquired more and more RV brands over time. Now, the acquisition of new brands has certainly slowed down for THOR and will almost certainly be slower in the future than it has been in the past. Part of that is because THOR is so big now. They, as you saw, had like 40% market share in a couple of the different North American segments. But part of that is also to do with prices. You know, they have other capital allocation options. They're starting to acquire their own stock. They, by my research, typically pay, when they go out and acquire new RV brands, the price to earnings multiple they tend to pay for those brands can vary quite a bit. The margins can vary quite a bit between different brands, but certainly year to year within a single brand. But they have been pretty consistent in paying somewhere in the range of 0.3 to 0.4 times revenues. That's not 3 or 4 times revenues or 10 times revenues like some of the software bros may have paid for certain businesses a couple of years ago, but 0.3 to 0.4 times sales. They've been pretty consistent with that. And if we look at THOR's guidance in terms of their own sales in the next 12 months, even after that big reduction in sales versus the last year or two, that would put their own stock at a little under 0.4 times sales. So I think for those couple of reasons, they're taking buybacks much more seriously than they might have done in the past. There's just not as many kind of needle moving acquisitions available for THOR now as there might have been in the past. Potentially it's even a little cheaper if you normalize their sales a little bit, and there's no execution risk when it comes to share buybacks. If they acquire a new business, there's a chance that that business works out great and there's a chance that it works out poorly. But when you buy back your own stock, you're really concentrating remaining shareholders' ownership in the existing businesses, and you know exactly what you own far better than potential new acquisition targets. In terms of just a couple of other thoughts on valuation and kind of the long-term potential for THOR Industries, I interviewed Jake Taylor relatively recently on the Investing with Tom podcast, and for cyclical businesses, he shared this framework of buying on book value and selling on earnings. When a company is going through a down cycle, often they can have a very high PE ratio, for example, not necessarily because the price is high, but largely because the earnings are depressed. So he tends to kind of fall back on the asset value that some of those companies have. And THOR's a pretty good example of that as well. Although the earnings are relatively volatile, the book value growth has been pretty consistent over time, and the returns that they're earning on their book value, or the return on equity, again are a little lumpy, but if you even out the bumps, have been pretty strong, in the high teens to even early 20% sort of range. So that's potentially a nice way to look at it as well. In terms of some of THOR's publicly stated long-term goals, in 2019 they held an investor day where they stated they wanted to reach 14 billion in net sales and a 16% gross margin by 2025. They actually met that target in 2022, so well ahead of schedule. Part of that explained by the COVID boom. So they ended up restating some new goals in 2022, in mid-2022, and they said by financial year 2027, so 5 years out, they want to get to 20 billion in net sales, 17% gross margins, $27 in earnings per share, and $6 billion or more in cumulative net cash from operations between FY23 and FY27. Now, if those goals are met, that would put the current price as of recording at about 0.2 times sales. Like I said, they've acquired businesses that they viewed as attractive purchases for 0.3 to 0.4 times sales in the past. You could argue that that ratio should even be a little higher potentially if the margins are really strong and you're keeping more of those sales in terms of owner earnings in the business. And the $27 of earnings per share would put them that would put them under a PE of 3 on current prices. So that is the potential kind of upside case, I suppose, for THOR. So those are really all the thoughts I have from this video out of THOR Industries' latest quarterly earnings. They remain a cyclical business. They have been in the past, and we're starting to see that again here moving forward as they potentially go into a down cycle. But it's nice to see management sort of consistently roll out their downturn formula, have been flexible with their costs, continuing to generate strong cash flow, and just being very disciplined overall in terms of how they manage the business. And like I said right at the start of the video, I think it's a really interesting case study of maybe tougher industry, good economics probably overall, but tough in the fact that it's cyclical, yet you have a business that's built a very good track record by, managing well through the cycles. So I do hope you enjoyed the video. If you haven't subscribed to the channel already, please be sure to do so. That way you can catch future content as soon as I upload it. But that's it from me for this one, and I'll see you in the next video.